Hey, what's going on, everybody? Welcome back to my channel. So today I just wanted to do a quick video sharing a book that I just finished reading a while back, and the book is called Expectations Investing. And the reason I wanted to make this video is because it definitely seems like this is a lesser known investing book. It's not nearly as popular as The Intelligent Investor or One Up on Wall Street or any of the more popular finance titles out there. But the lessons in this book are extremely valuable, in my opinion, especially in today's investing landscape. So I want to go over the central ideas in this book and also why I think it's a great read and really why I think anyone who takes investing seriously should pick up a copy of this book. And I can honestly say that I've taken several finance courses back when I went to university, and this book taught me more about how to identify good investing opportunities more than any of those courses that I ever paid thousands of dollars to take. Now, I think this book really resonated with me because it really put into words an investing strategy that I myself have been using for a while now, and what I use in my videos when I show my analysis to you guys. And the title of the book, like I said, is Expectations Investing, but also Reading Stock Prices for Better Returns. So the idea behind it is that investors should use the information embedded within a stock price and thus the market cap of the company to understand what investors are collectively expecting from the company, meaning how well they're expecting that company to perform into the future. And it's an important idea because I often hear new investors who are getting into the stock market and I ask them, why are you investing in these specific companies? And they list off their reasons. And typically it's, I think this company is going to grow for X, Y, and Z reason. And then I try to explain to them, well, yeah, they may grow for those reasons, but you have to understand the extent to which that growth is already being priced in, because there could be a scenario where the company ends up doing exactly what you think they'll do. But if it's already priced in, then you won't make any money by investing in that company. And it's a difficult concept for a lot of novice investors to understand. And I think this book really just put into words something that I myself have been struggling to explain to people, and something that I think more people who get into investing really need to understand. Now, something else that the book went in depth on, which is something that, again, I really liked, was why focusing on earnings, price to earnings multiples, EPS, can actually be detrimental and is definitely not the only thing you should be looking at. So they gave an example in the book, and I kind of redid the example in my own way. It's the exact same concept, just with different numbers here. So let's say you have a business, it's a purely equity finance business. So they have no debt, meaning they have no interest charges. They have no capital assets at present time, which essentially means that their earnings are also equal to their free cash flow because there's no capex, there's no depreciation. Now, this company we know for a fact is going to exist for the next 10 years, and they have an 8% cost of capital. So let's say year one, sales are $1 million, operating expenses are 800,000. So they have 200,000 operating income. 25% of that gets taxed. So then their earnings slash their free cash flow, because we're assuming the same, is 150,000. Now, let's say this year one happens every year for the next 10 years. The value of that company, if we discount it the cost of capital, which is 8%, would be this right here, just over $1 million. Now, let's say in year two, the company has the option to invest $100,000 in new equipment, and this new equipment will produce $6,000 in after-tax profit every year for the next 9 years. So it's going to increase their earnings. It's going to increase their cash flow. You would think that by doing those things, it would increase the value of the company. But if we skip down to here, the value of the company actually goes down when they make this investment. And the reason behind that is because they're earning 6,000 in after-tax profits on a $100,000 investment. So that's 6%, call it return on invested capital for this project specifically. But we know they have an 8% cost of capital. So cost of capital exceeds the return on investment that they'll get in this project. Therefore, they shouldn't do it because it's actually going to decrease the value of the company because you're discounting the future cash flows at a rate that's above what the future cash flows will increase at, which is only $6,000 if they make this investment. So in year one, this is how the cash flow gets calculated. So you have the earnings here, which is the same as the earnings here, 150,000, except you add that $6,000 that they're now going to get. You subtract that investment because it's a capital expenditure. You have to deduct it. So then your free cash flow is only this amount here, 56,000. But your earnings slash free cash flow, again, it's the same thing in this example for years 2 all the way to 10 is going to be $6,000 higher, so 156,000. But the value of the company actually goes down. It goes down by about 5% when they make this investment. But the thing is, their earnings are up. Their earnings are up year over year. So if you're valuing the company just based on earnings, you would think that the value of the company has increased. But actual true shareholder value has declined because the investment they made does not at least earn the cost of capital. Now, the other core lesson of this book that I want to talk about in this video is how they offer a framework that you can use for valuing growth companies. Now, many people who watch my channel, I would think would consider themselves value investors. And one of the problems with value investing is that it's very easy to get pigeonholed into only looking at certain companies and dismissing growth companies with high valuations. And sometimes value investors will have this sense of superiority that their investing strategy is the only one that works. It's been proven over time. And all these people who are buying these high flying companies with ridiculous valuations are just idiots. And this is kind of a toxic mindset to have, because you have to recognize that we live in a world today where many companies have become very successful very fast. So despite how overvalued some companies currently are, that can change very quickly. And companies can grow today at very exponential rates. And if you're talking about software companies specifically, that tends to be a winner take all market. So even though some companies do appear to be extremely overvalued, you can argue that it is in some cases justified. Not always, but in some cases. And another thing I want to point out is that there was a study done by McKinsey. McKinsey is a global consulting firm. They're very well known, that found that the average lifespan of companies in the S&P 500 in the year 1958 was 61 years. And fast forward to today, the average lifespan of companies in the S&P 500 is 18 years. So 61 years to 18 years. So why is that? Well, it's because the speed of innovation has increased quite a lot. And they even went so far as to say that a decade from now, 75% of the companies that are currently in the S&P 500 will no longer be there. They'll either be bought, they'll go bankrupt, whatever the case may be, they won't be there anymore. So businesses can change. They can get very big very fast. And yes, there will always be companies that are losers, but don't dismiss the company just because the valuation seems to be expensive. You have to be open-minded. And really what investing is, or value investing, is buying something for less than it's worth, right? So whether that's a growth company, a value company, it's all really the same thing. And I think we're seeing this now with Tesla specifically. Tesla is a company that a lot of people have been asking me about, and people have been calling it overvalued really since it IPO'd. And the framework that I have on screen here that I'm going to talk about in a sec, I think can be used to explain Tesla's valuation. Whether or not you think it's correct or not, it can be used to explain it in some way. So they call it real options value. And it's essentially that the additional value that should be assigned to a business to account for new markets that they could enter into the future. Now, many businesses have the ability to enter new markets, expand their businesses, but it's uncertain whether management will actually decide to enter those markets and if the company will actually be successful if they do decide to enter those markets. Now, this model here is extremely theoretical, and I don't imagine it's supported by any sort of empirical evidence, but it does kind of intuitively make sense. So this Excel sheet you can download from the Expectations Investing website that I was on at the beginning of this video. But they're saying that they actually use Shopify in this example. And this was back in September of 2020, I think, when Shopify was at 900 a share. I believe it's higher than that now. But basically, they're saying that, say Shopify's current share price is $900, and you do your evaluation of the current business, so not future businesses that Shopify may enter, but just as it is today, and you think it's only worth $800 a share. That means an extra $100 per share can be assigned to new opportunities for Shopify, whether that's they expand globally, or maybe they leverage their knowledge of their existing customer base to offer additional services to their merchants. And then if you multiply this by the amount of shares that they have outstanding, you get about $11.3 billion that is of Shopify's value that is due to future opportunities and businesses that they may enter. And they actually use the Black-Scholes model to calculate the size of the market opportunity that must exist for this extra $11.3 billion in value to make sense. And the variables are kind of designed to work like an options contract. They're essentially pricing a business expansion opportunity as if it's an option that you could exercise. And you can see how it accounts for things like project volatility. So, how risky is this new business that they may enter? How many years is the expansion opportunity available? And a few other factors as well. I don't want to bore you with the mass of the details, but the end result is that it calculates that a $46 billion business opportunity must exist for Shopify to justify this extra $11.3 billion in added value. So it's an interesting way to look at these growth style businesses because it forces you to think about businesses and what new places they could expand to, and then what extent is that already being priced in. And this would be definitely helpful with a company like Tesla because a lot of people are pricing Tesla based on new businesses that it could expand to in the future. So those were two main takeaways that I personally got from this book. There are many other lessons, and what you'll find about the lessons in this book is that they are enduring. They're not just lessons that apply in today's world and won't apply tomorrow. They're always going to apply. And they also have many chapters on things like how to read signals sent by companies. For example, what does it mean when a company decides to triple the amount of money that they're spending on buybacks? Does management suddenly see their stock as undervalued? Also, how to assess things like acquisitions. Acquisitions are where a ton of capital gets allocated. Many Canadian tech companies in particular prefer to grow through acquisitions, as we've seen in several companies we've analyzed on this channel. And you also see it in emerging companies, but also established companies like Constellation is one company that does a ton of acquisitions. And where a lot of focus gets placed on acquisitions is on the immediate impact on EPS. Does the acquisition increase or decrease EPS? When the book points out, it should really be a focus on synergies, the benefits that entities get when they combine each other. Does that account for the premium that was paid to acquire that extra business? And what was the market's reaction to the acquisition? Did they discount what was actually a good deal just because it dilutes current EPS? And if that's the case, then maybe you do have a good buying opportunity. So those are just a few lessons. Again, highly recommend this book. I'll drop a link in the description of this video if anyone is interested in getting it. But that pretty much does it for this video, guys. So thank you so much for sticking around and listening. I hope you did find this useful, and I'll see you in the next video.